actually has seen prices rise sharply since 2005. So think about it. Already in Australia in 2005, it looked like a housing bubble. And yet, here we are 6 years later, and prices are much higher. I don't know the exact numbers, but I think 20 or 30% higher than in 2005. Interestingly, Australia is the only major developed country, at least that I'm aware of, that did not suffer a recession in this crisis. And what this tells us is that, to some extent, the health of the housing market reflects the business cycle. Now, I don't mean to suggest that's the only factor. Again, in the subprime sectors of the United States, I think even if we didn't have a recession, those areas would have suffered. But the total decline in asset values was higher than necessary because of the recession. So it was two problems. A lot of discussion recently on the need to reallocate resources. This is sort of a reallocation theory of the recession, which is this. Once the subprime bubble collapsed, you had all these unemployed construction workers. These people needed to find jobs elsewhere, so it was inevitable we were going to have a recession. I think that's wrong. It's right, but it's wrong in terms of the scale of the problem. What was inevitable was that the U.S. economy was going to have a slowdown because of this subprime bubble bursting. But if you look at this red line, again, it's a little hard to see the data here, but it peaks in 2006. This is housing sales, I believe. But if we had done construction, it's the same pattern. Construction peaked, for instance, in January of 2006. Now just keep that date in mind, January of 2006. By April of 2008, housing construction had fallen more than in half. Most of the decline took place between beginning of 2006 and April 2008. And yet, by that time, unemployment had only risen to 4.9%. So there had been very little increase in unemployment. The unemployed construction workers were often working in commercial real estate and manufacturing. Exports were booming during that period. Other fields. And then in late 2008, output fell across the board in the economy. Most sectors, services, manufacturing, construction, everything went down sharply. Unemployment skyrocketed to over 10%. This graph shows some data connecting nominal GDP and the size of the financial crisis. These are estimates from the International Monetary Fund. Now, the white line shows you their estimate of the size of the banking losses in the United States in different periods. So they estimated in April 2008, then later in 2008, this is January 2009, April 2009. So in early 2009, estimated losses were almost 3 times as large as in April 2008, even though the subprime crisis was fully understood. And it was known, these are very large losses even here, almost $1 trillion. But when the economy weakened in late 2008, the estimated size of the losses in the banking system almost tripled, indicating to me that maybe as much as 2/3 of the problem with the banking system was recession-related. On the other hand, when the economy started to recover, the estimated losses got smaller. So the other graphs are their estimates of inflation and real GDP growth. I couldn't actually find a separate estimate of nominal GDP, but that's the sum of inflation and real growth. So these two lines falling here show that forecasts of nominal GDP growth were falling sharply and then rising after recovery started. Policy implications. My preferred policy is to stable nominal GDP growth. This is different from most central banks that favor targeting inflation. So since nominal GDP had been growing at about 5% annually, I favor a policy of sort of sticking with that growth rate and aiming for about 5%. And I think that would have done much better in a crisis. Targeting the forecast, I've proposed creating a nominal GDP futures market that would provide guidance what the market expects nominal GDP to be. We already have market expectations of inflation I showed you from the TIPS market, but a market forecast of nominal GDP would be very useful. Lars Svensson, a famous economist at Princeton and also the Swedish Central Bank, suggested using internal Fed forecasts. And one way of explaining this is to imagine a captain steering a ship across the ocean. And imagine asking the captain where he hopes to end up, and the captain says New York, and then you ask him, where do you expect to end up? And the captain replies, well, given current currents and waves and wind conditions, I expect we'll end up in Miami. So I'm aiming for New York, but I currently expect we'll land in Miami. You'd probably ask, well, why don't you turn the wheel a little bit and adjust the course to reflect the currents, the winds pushing the ship off course? Why don't you set your course such that your forecast of where you're going is the same as your goal variable? And this is basically what Svensson is recommending for central banks. If they want, say, 2% inflation, then adjust monetary policy so that they expect to get 2% inflation. If they want 5% nominal GDP growth, set policy so they expect to get 5% nominal GDP growth. And in late 2008, they were not doing this. Both inflation and nominal GDP forecasts were falling well below expectations, or well below their goal of what they wanted to achieve. Oops. What happened here? I sped through these accidentally. Okay. I've got it. Okay. I just hit the button too hard, I think. Thank you. Okay. Here's a good example of what I mean by targeting the forecast. The most important Fed meeting in this crisis was in September 2008, 2 days after Lehman failed. The Fed voted to keep interest rates unchanged at 2%. Now, in retrospect, I think that was a mistake, and probably even they would agree it's a mistake. They probably should have cut interest rates. Interestingly, they said the risks of recession and inflation were equally balanced. They were looking backwards at historical inflation data that had showed very high inflation over the previous 12 months. But the TIPS markets were showing that inflation was likely to be very low, in fact, below the 2% target that the Fed is usually assumed to implicitly have. And it was actually only 1.23% on the day of their meeting, inflation over the next 5 years, annual inflation. So if they had been targeting the forecast, they would have cut interest rates sharply because both inflation and the recession worries both indicated rate cut was appropriate. Now, the analogy I use here is steering a car. It's as if they were steering the car by looking in the rear view mirror at past data, the last year's inflation data. And if you try to steer a car looking in the rear view mirror, you're going to be all over the road. I'm arguing they should look down the road at the point they're trying to reach and steer towards that point on the horizon of what the goal of monetary policy is. So, what should have been done? I'm not going to get into all the technical points. I think I'll leave some of these to Q&A. But Ben Bernanke, about 8 years ago, told the Bank of Japan you need to show Rooseveltian resolve, meaning you have to be determined to provide a boost in aggregate demand or raise prices if you want to. At that time, Japan was suffering from deflation. So the central bank has to be very strong and aggressive during a severe crisis, cannot just be passive. Leaving interest rates constant can be effectively tightening monetary policy if the economy weakens and credit demand falls. They should have first lowered interest rates to enough to achieve on-target growth for inflation, and then promise to do what's called level targeting, which is to make up for any near-term shortfalls. So if they're aiming for 2% inflation and they only get 1% one year, they should try to get 3% the next, so that inflation averages 2% over the whole business cycle. That's something that Ben Bernanke recommended that the Bank of Japan do, but interestingly, the Fed has not done that. in similar circumstances, I would argue. Okay, what else could they have done? They adopted an interest on reserve program, paying interest on bank reserves, and I understand why they did this. With all the money being pumped into the banking system, they were worried about high inflation. Normally, expansionary monetary policy is highly inflationary, but they actually overreacted, and we ended up with deflation over the next year because they paid interest on reserves for the first time in Fed history, which encouraged banks to hold on to the reserves instead of moving them out into the economy. Now, ironically, they probably will need this program during the recovery, because with all this money there, there's a danger of excessively high inflation during the recovery unless they pay enough interest on reserves to encourage banks to hold on to some of this money. But they essentially did a program that might be needed at some point too early, is what I'm essentially arguing here. And a similar mistake was made in the Great Depression in 1936 and 7, when they doubled reserve requirements. Increased demand for reserves is actually deflationary. I recommended a negative interest rate on reserves. I think I was the first person to do that in an article, but I'm not certain. Anyway, the Swedish Central Bank did a little bit of that in 2009, so I was happy to see that. And interestingly, I don't know if this is why, but Sweden has recovered more rapidly than other Western European countries from the recession with this program. They should have done the quantitative easing that they did in November 2010, 2 years earlier. So I have been very critical of fiscal stimulus, which was the path pursued by the U.S. government. Mostly spending increases, maybe some tax cuts, but deficit spending basically. I didn't think it'd be very effective, and I'm also worried about large deficits. Monetary stimulus does not require deficits, and I think it also can be more effective. When fiscal stimulus seemed not to be working very well in the middle of 2010, we'd had persistently high unemployment for quite a while. Policymakers went back to monetary stimulus and adopted the quantitative easing program. Now, my prediction was that if they did do quantitative easing, you should observe higher stock prices on the rumors of quantitative easing, and we saw that. A weakening of the dollar, we saw that also on rumors of quantitative easing. Higher tip spreads, that is somewhat higher inflation forecasts, and they went up from about 1 to a little over 2% with the quantitative easing. So it does seem to have had the effect on asset prices that I had predicted earlier. And I'm not trying to claim to be someone that can predict the future of the economy. I want to assure you, I was as caught unaware by the crisis as most economists. What I do is I make conditional forecasts. That is, if they do this, this is what should happen. And a crisis, by nature, almost is very hard to predict, a banking crisis. Any of us that could get rich by speculating in the markets if we knew when crises were coming. But at least we should, at a minimum as economists, be able to make conditional forecasts that if policymakers do this, here's the result you should get from that policy. And also, the results were consistent with the predictions in Michigan's textbook. I'm going to just, I know I've run over a little, let me just finish up with maybe this slide and I'll take questions. I have a different take on policy from most economists. Most economists take what I call a wait-and-see approach. Do policy and wait and see how it works. I think the markets tell us right away whether policies are likely to be successful or not. Whether we've done enough policy stimulus will show up in things like the TIPS markets, where we can see inflation expectations. And if we're targeting the forecast, driving the car, looking down the road, we should be able to look at all sorts of market indicators to tell us whether what we've done is adequate or not. And the markets were telling us from September 2008 that the monetary stimulus was inadequate, and in retrospect the markets were right. The performance of nominal GDP falling so far below trend indicates that we would have been better off with a more stimulative monetary policy at that time. And I think it's a scandal that the government has not set up and adopted a nominal GDP futures